had a bit of a break. It's been about 3 months since we had the last one. I think I promised to have a lot more events, but I think it seems like every time I make a big promise, it doesn't seem to happen. So I'm not going to make any big promises this time. But thank you so much for being here. I have some exciting updates to share about Spike, but before we jump onto that, first of all, I'd like to welcome all the delegates who have come to DigiCon Sri Lanka to spend your valuable time here with the local ecosystem. Would really appreciate that. And also a big shout out to all the organizers of DigiCon 2030 as well. Right, most of you know this story, but there are some new faces here, so I wanted to give you a bit of a brief about. We started back in 2014, 10 years ago. It's been a long time. Started as a platform or like a place for people to, founders to, startups to come and sort of network, connect with like-minded people. Eventually we have evolved into a larger community. As you can see today, I think for this event we had over 300 registrations, 300 plus registrations, and then I counted about 150 people here today, and I'm expecting a bit more. Started as a platform to connect, but it's grown into this awesome community. And over the last 10 years, I can comfortably say we've hosted over 75 to 80 meetups every month. And we've had a lot of prominent names in the Sri Lankan startup ecosystem coming and sharing their experience, knowledge, insights. Not just the founders, investors, policymakers, professionals. So it's been awesome, and then we've been growing this community every day. Quick update about the future of Spike. 10 years, and we have some big plans for this year, but no promises. First of all, we want to expand into other cities. We tested this out last year with Ahangama, which was a very successful event. We had over 100 plus people coming into that event. Not just the Sri Lankan, the local community, but there were a lot of expats too. They've been asking when are we coming back. So we wanted to sort of work on that, and then we want to try and do a few more events in South, and possibly one event in Kandy before we wrap up the year. Because this is our 10th year, we've been, the organizing committee, we've been talking about, sort of doing maybe like a one-day event. So something is in the works. We still don't know what the event is going to look like, but we are working on something. Third one, in order to work on all these ideas, so I'm going to take a step back from the Colombo event, and then I'm going to hand over this event to two promising individuals. We have just over there Nevan from Code 94 Labs, if you can raise your hand, and Sachin from Tiaga.lk. These guys are very close to the local startup ecosystem, and they'll be taking over from me for the Colombo event, so that I can take a step back and focus a lot more on the South event and then maybe Kandy as well. Never wanted to monetize Spike, however, we wanted to make it sustainable. So we are open for sponsorship opportunities. This is something that we haven't done in the past, but as of this event, we'll be doing. And we have a couple of sponsors come on board for this event, and we are very grateful for that. We have Inventures as well as Fastco came on board as sponsors. So big shout out to them as well. Let's get to the exciting part all you have been waiting for.
Mohan, a bit more about my background. I'm based in Singapore. I run a company called E27. We're a tech ecosystem platform. We do business matching activities between startups, corporates, investors. We run meetups like this, as well as large-scale conferences where thousands of people from around the region come. And then we work very actively with corporates, mainly growth stage companies, large technology corporates and governments, to help facilitate business matching across the region. You need investors who are local. That means ideally, Sri Lankan, they might have studied abroad or lived abroad for a while, but they need to be local Sri Lankans. They need to have raised capital from LPs who are ideally local as well. Not just international investors, but ideally local families, local corporates, local angels. And they need to be exclusively investing in local companies. So 100% of their fund has to be dedicated to Sri Lanka investments. And there are a few funds in your ecosystem that are here, which is a very good starting, promising sign. And that's the same thing that happened in Singapore in the early days. Right? There were a few funds that were popped up by the government through some level of a grant program, but some of them were attracted from overseas, and these hired local fund managers. So this world, right, if you look at the stats and the data, the average age of a successful founder is 42. Right? So in order for an ecosystem to grow, you need an older batch of founder personas to come in and either disrupt spaces that they've had long-term working experiences in, or join and be co-founders with other startups that are actually trying to disrupt their space. So over time, I do expect the Sri Lankan ecosystem to actually start to get older, and for investors to then start wanting to back more senior founders. The fourth part is in infrastructure layer. Right. There's a significant amount of investment done in infrastructure, whether it's everything from space. When I say space, I mean things like co-working spaces, office spaces, to support for grant programs or business programs, to even working with government to allow for better procurement practices that needs to happen. So that took about 10 years in Singapore to really realize, and I think that's something interesting for the Sri Lankan ecosystem to learn from. How can government and corporates come up with the right policies and programs to better work with startups and support them in their journey to allow them to be their customers, right? And then the last part, of course, is a healthy M&A exit ecosystem. I think that Singapore is still figuring that out. I think the whole of Southeast Asia is really still figuring that out. It's not the best use case or example, but I think what the founders in Sri Lanka can learn from is that rather than wait for this hypothetical exit scenario of getting acquired, start building financially sustainable companies. Start looking at revenue from day one. Start looking at how you can raise in a responsible manner, not raise too much, but raise enough and a bit of extra, but raise in a manner that allows you to scale revenue and get to a level where you're EBITDA positive really quickly, and you can build a financially sustainable hub. The unicorn play, in my opinion, is something that is a replica of Silicon Valley and a Blitzkrieg model that isn't entirely relevant to this part of the world, right? So I think more and more investors are going to look for good rhino companies, which are basically companies that can get to up to 100 million in revenue, but be EBITDA positive and profitable. And that seems to be the playbook that's fairly, I would say, sustainable and relevant now in Southeast Asia. Even for my own fund, Orwell Ventures, we don't look at unicorn huntings or finding, our model's not based on looking for unicorns. We are looking for really good $100 million companies, and the best case scenario for us is maybe a $500 million exit in this ideal outcome. Right, so I think that pretty much covered the first part of the question with respect to Singapore, and maybe on some level what Sri Lanka can learn from it. The second part is why Singapore can be a good launch pad, right? Firstly, Singapore provides a really good framework for law, for fairness, for ease of doing business. So for any entrepreneurs who have set up their companies in Singapore, they would have probably realized that it's easy place to do business. There's very little cultural and language barriers to wanting to do business. Unlike maybe some other Southeast Asia countries where there's an element of a relationship building that's needed, or past history of doing work together, Singapore is actually quite open to working with organizations regardless of whether you're local or foreign. So that makes ease of doing business really easy. If you're raising money from VCs especially, if you're raising money from a global pool of investors, having a company based in Singapore can be really helpful, because most investors will want to invest in an entity that is Singapore based, and even we do the same for companies in Indonesia, Vietnam, Thailand, Philippines. In all of cases, like all of these have Singapore entities. And lastly, right, if you're looking to work with corporate companies, typically the larger tech MNCs, a lot of them have their APAC headquarters in Singapore. So finding the key decision makers, working with the folks that actually have budgets, can really facilitate the discussion really well. There are a lot of other good reasons, but I would say these top 3 reasons are what would make you want to really seriously consider basing yourself in Singapore, or at least shifting your corporate headquarters in Singapore. And the last part of the session that I'm supposed to share on is on mistakes that founders make, right? Well, this is a tricky one, right? Because to be very honest, I mean, the founder journey is in my opinion, right, one where if you're not making mistakes on a daily basis and learning fast enough, then you're probably not making enough mistakes, right? And the function of your growth, right, is also a rate at how which you are trying, failing, and then bouncing back up, right? But if for a company that's starting out maybe in the pre-seed stage, that is trying to get its initial round of funding going, or maybe trying to figure out product market fit, I think the few mistakes that I would like to talk about Firstly, with respect to fundraising, right? In my opinion, fundraising is a sales exercise, right? Too many founders take fundraising as a relationship exercise. And I think if you look at platforms like YC and a few others, the way fundraising is treated is as though you have a very clear timeline, you have an exact lead list of investors that you want to go after, and you structure that process out in a very, very tight mechanism model. I think if you search for enough models from online and if you talk to enough YC founders, they can share the entire playbook with you. But my one mistake I see that founders do is that they treat fundraising as a dragged on 6-month process when it really should be a very tightly compressed, at max 3 months process, especially if you're in the seed stage, and it should be handled like a sales related function. The same way, if you're a BD or sales guy, you have a lead gen pool, you have clear sales targets that you need to get to at the end of the week. The same logic applies to fundraising. I can go in a bit more depth on how to expand on that later on, but on a high level, treat fundraising as a sales-centric process, not a long, drawn-out relationship-building process. The second thing is really on the getting to revenue quickly, right? I think nothing beats validation than revenue, right? So if unless you are in a certain segment of companies, for example, developer tools or a few other segments where you need to build your product out for a significant period of time before you can generate revenue. Figma is a very clear example, right? If I remember correctly, they were building for 5 years before they even got revenue, right? If you're not in those areas, get to revenue quickly, right? It's imperative to be able to understand what average order values from your clients are, what the CACs are, what the LTVs are for your client, because that kind of data can be tremendously helpful for you to plan everything out moving forward, from the kind of people that you need, to the kind of business that you need, to the kind of runway that you need, to the amount of money you need to raise. So get to sales fast. If you can structure your OKRs in a way that allow you to get to sales as quickly as possible, do it, right? Nothing beats the value of getting that first customer through the door. And last but not least, right, is that I'm sure you've heard this before as a cliche, but it's really a marathon process. It's not a sprint, right? So if it's a marathon process, prepare for the marathon well. Fuel up well, train well, and make sure that you have a way to keep yourself going for a long period of time. Most companies don't really work well until maybe a year or plus out. Some companies might even need a longer time to figure out product market fit, right? What you don't want to be in is a situation where you sprint too hard, you die out, burn out, and then you don't see the light of day with respect to your companies. Be sustainable, take care of both your physical and mental health, and realize that doing 15-hour days over a long period of time is just fundamentally not sustainable. You're better off giving yourself consistent effort, taking proper time off over the weekends to grow, for example, spending quality time with family, friends, and then coming back the next week refreshed and strong, right? And if you do need to do compressed periods, make sure they are compressed over a tighter period of time, like a 2 to 3 month sprint process, as opposed to a dragged out 1 year process. So I think timing-wise, I think we should be fine. I got a go ahead from the guys behind. I hope you all got value from this, and I'm looking forward to connecting with you guys one-on-one individually. And once again, thank you very much for having me.
Thanks, Mohan. And the problem with early stage fundraising, especially in more emerging markets, is both the founders and the investors are unsophisticated. And so if you're trying to raise too early, you're wasting your time with somebody who's not going to give you money anytime soon, right? Even if you are within the range of their typical maturity of investment profile, VCs typically take 6 to 12 months to invest. And so if you need money in less than a year, a VC is almost never the right solution for you. And there's exceptions, and usually it takes much longer. And so who should you be fundraising from? Usually it's angels and family offices. And the challenge there is, where are these angels? They don't have websites. Usually they don't on their LinkedIn say, I'm an angel investor. And so you need to find out where they are, and that's angel networks, networking groups. But you can make your own angels. That's one of the favorite things I like to teach founders. What vertical are you in? Are you in medtech? Go talk to some doctors. Go talk to some people who run hospital chains. Go talk to people in your industry. They might never have invested in a startup, but they care about medtech. They're passionate about it, and they know something about it. They might be interested to give you 10K. And you can create your own angels. We see that time and again. But a lot of founders have their blinders on. They think, I can only raise money from people who have a business card that says they're an investor, or a website, or they're officially a member of an angel network. The majority of angel investments in the United States happens from random doctors and lawyers who meet interesting founders doing interesting things and they give them 10K. So keep your eyes open, family, friends, religious institution networks. What are all the networks you can draw from for whatever resources you need? Could be employees, obviously cash. Let's see. So we invest internationally, mostly in emerging markets in South and Southeast Asia. We recently made our first investment into a company in Sri Lanka called MintPay, which is a fintech company. And I think maybe some things to talk about them. Why did we invest in MintPay? Okay, number one, the founders knew their stuff backwards and forwards. So when I interview founders for potential investors, one of the things I'm going to test you on is how well you know your own business. And it's surprising to me how many founders don't know their own business very well. So here's a question. What was your revenue this month? What was it 3 months ago, 6 months ago? What will it be 3, 6, 9, 12 months from now? And if you can't rattle off the ballpark number without referring to notes or getting back to me later, you've already failed the interview, right? Because you don't know your business well enough, right? So there's a hack. You need to be able to answer questions really quickly, or you need to be able to at least give a ballpark and say, if you want the specifics, I'll get you the financials by tomorrow. This is a personality trait called conscientiousness. You should be diligent about your business, you should be organized with it, and you should know it backwards and forwards. And if I need data, you can get it to me in hours, not days or weeks, yeah? So that's, a green flag if you're good at that, and it's a red flag if you can't do that. So, and I think that applies to every investor you're gonna come across. The more competent you are with your communication, the more clear and efficient you are with your communication. The number of founders, when I ask a question and 3 minutes later I still haven't heard the correct answer, is astounding to me. Right? So practice efficient communication with your speech. Don't lose track of the question. There's nothing more annoying to me, at least. So those are kind of two little tips. Obviously one challenge of Sri Lanka is the market, and VCs are typically looking for you to have $100 million in revenue in 5 years. If your business can't do that, you're not a VC investable business. And that's okay. You can have a really nice SME business that can make you rich and can make your employees rich and can be a really awesome business, but you're just not going to be a $100 million company in 5 years. The velocity is just not there, and that's okay. But it's very important that you're extremely honest with the self-evaluation of what type of business you are, because if you are not a startup, then you're an SME, and you should be going after SME investors, not startup investors, because it's going to be a waste of time. You're not going to raise much, if any, money from the startup investors, and you're going to miss getting money from SME investors that could be giving you money. So I think that's another tip. Just be really honest about that. And in a market like Sri Lanka, it's harder, smaller market, right? So there's fewer opportunities for getting to 100 million in 5 years than India or the US or whatever. But we invest across 15 countries so far. We've done a lot of investments in Bangladesh and Pakistan and India, and they all have to deal with the same question because not only is the market fairly small, but the average revenue per user is much smaller. So even my Indian companies complain about their friends in the United States who can charge 10x per month for the same product. And they're like, it's not fair, we're doing the same amount of work and we just can't make as much money, and that's just the way it goes, right? So what else do we look for? I think the normal stuff is the team, like why are you the right people to be doing this business, right? So what's your UVP, what's your unique value proposition as a team? And that's typically the weakest slide and the weakest point that investors make when they talk to an investor. So they're usually like, oh, I worked in IT for 5 years. And I'm like, okay, well, what did you do why is that impressive? Like, how does that, I didn't work in IT for 5 years, but as far as I can tell, I could be just as good a founder at this business. Like, why are you the right one to do that, right? So really think through that. If your role is in sales, then talk about sales success. I worked for this other company, and in just 2.5 years, my department 20x'd our sales, and revenue went up X, Y, Z, whatever. So be specific about why your team is the right team to do it. If you worked in the industry for a long time, whatever the case may be, but really focus a lot more on that slide. That's typically the weakest slide. On your problem and solution, quantitate the problem. So I hear way too many people say, oh, our problem is this really large problem. And I'm like, how large? How many hours per week or per month is this costing your potential customer? And usually it's dollars or time, right? And then your solution is the delta. So right now, this type of customer, so the persona should be defined fairly specifically too. And you can Google all these terms like customer personas and stuff. They spend 40 hours a week doing this, and they make this much money per year. And so that's, let's call it a $3,000 per week problem per this type of company. And there are 30,000 of these types of companies in Sri Lanka, or whatever your market is. You've all of a sudden defined your total addressable market, right? By doing that, you're multiplying time by dollars by a number of potential customers, right? And then on your solution, you should say, with our solution, you can save 40% of your time, and then the investor can convert that into dollars. And that's the value proposition. That's the investor is trying to identify the dollar value of the value proposition at scale. And then you just have to convince them that that is feasible to get there. And then you've created a market, and it's defined as dollars. And then they obviously do their whole breakdown of like, all right, you're gonna be worth $100 million, and today you're asking for $5 million. Does that make any sense? Blah, 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 whatever. And then lastly, which I think is another challenge with emerging markets, is nobody expects you to necessarily hold yourself to this, but what's your exit strategy? And I think it's a big problem. Mohan talked about it. Even in Singapore, it's a big problem. How is the investor gonna get their money back? If they give you $100,000, who's gonna be the one that gives them the 100,000 plus 100,000 or whatever the number, hopefully a lot more than that. Who's that gonna be? Is it gonna be another big company in Sri Lanka? Is it gonna be an Indian company? It's probably almost definitely not gonna be an IPO. So at least have that story ready to talk to. Again, it just makes you seem like you've thought things through, you're strategic, and you have big eyes. You're thinking about 5 years, 10 years from now, right? So I guess another red flag is short-term thinking. Oh, we're gonna do this, we're gonna do that, by the end of this year, we're gonna have this revenue. And I'm like, yeah, well, what about 2, 3, 4, 5 years down the road? Because when an investor invests, it's potentially a 10-year plus relationship, right? So I think Apple took like 13 years to IPO. One of Steve Jobs' quotes that I liked the best was, I think the newspaper said something about Apple being an overnight success. And the quote was, it's amazing how long it takes to be an overnight success. And that's how startups work. Usually nobody hears about a startup, and then all of a sudden there's a funding round for like $1 billion. And people are like, whoa, this came out of nowhere. And the founder's like, I've been doing this for 17 years, man. And that's how startups are. So anyway, all right, I think I rattled on long enough. I'm happy to talk more in Q&A. I think I hit most of the topics. If I didn't directly, apologies to the organizers if I kind of went in a roundabout way. But hopefully that was useful. I guess as a sign off, we actually just launched our applications for cohort 10 of Accelerating Asia. So would love to have you apply. You can just go to acceleratingasia.com and fill out the application. Even if you think you might be too early or not a good fit, the application itself answers a lot of questions that any other investor is going to want to know. So it's good practice for you to have everything kind of organized and ready to go, and you can kind of create your own data room from that if you don't have one already. If you don't know what a data room is, go find out. Awesome. Thank you so much, everybody. Appreciate it. Look forward to Q&A and meeting some of you later on. Thanks.
Q&A session, and I also invite Mohan and Craig to be a part of it.
Few questions we're going to set aside for our speakers today, but we would like all of you to ask as many questions as possible. Yes, so thank you so much for that insightful conversations that you had with us. To kickstart, I'm going to ask a hard-hitting question. Is the investment climate in Singapore for Sri Lankan startups?
There's an analogy I was giving her earlier where if you compare, let's say, US and UK, in America, if you have a meeting with an investor or an individual, there's a follow-up immediately after the meeting, there's intros done, there might be a follow-up session happening, whereas in the UK, the follow-up might happen a week later, and even that follow-up might ask for clarifications on the last meeting that you had 1 week before, right? So I think on one level, pace matters. On the second level, it's the quality of the interactions also matter. So again, as Craig pointed out earlier, there is a base level benchmark of expectation when a founder goes out there to try and raise capital with respect to how much they know about the business, how much they know about fundraising, and how much they know about the processes and the systems in place. Like on the base level, you should know how a term sheet looks like, you should know how a sales looks like. And if you don't, right, the base expectation is that you should have figured it out by the time you went through your fundraising process. Right? So I think on that part, right, the Singapore ecosystem, from an investor standpoint, can be a bit competitive and rigid, especially if you are a new investor. If you're new to a startup and you are doing this for the first time, it's less forgiving. But on the flip side, if there are enough platforms that exist that allow you to do that process. Now, the last part is really business culture mindset. The expectation is for you to move fast. So investors in Singapore, on average, not always, but on average, will tell you fairly quickly if they're coming in or not. Like for Orwell, we try to make it like within a 2, max 3 week period. We'll say, yes, we're in, or no, we're not in, and this is exactly why we're in it, right? The worst kind of investors are those that can drag it out for months on end, right? So I think the ecosystem needs to collectively work together on the founder side to make sure you get up to speed from a knowledge standpoint, get up to speed from a skill standpoint, but also be really like quick and hands-on and fast in terms of the follow-up. On the investor side, right, to make sure that you don't waste the founder's time.
Singapore or Silicon Valley or London, go to the tier 1 places, get immersed in the culture, understand the norms. Because if you can absorb those, basically you're set from a culture perspective, and you understand the terms, you understand the language. There's a whole kind of subculture of, safe note, CN, cap, discount, liquidation preference, full ratchet, preemption rights. There's like 100 of these that you need to know. And if you don't know them, you're going to come across as less sophisticated than everyone else. And even if your business is better, you'll have a harder time. So I think immersing yourself in the kind of best-in-class cultures is good. I wish I'd done more of that as a founder. I should have spent more time in the Valley, and I would have had things happen to me faster. So I think that's good. Infrastructure-wise, it's really easy to set up in Singapore. If you're trying to raise money in Singapore, you have to have a Singapore entity. Don't go to Singapore and say, oh, when I get a commitment, I'll set up a Singapore entity. It's $300. It takes like 24 to 48 hours. You don't need to set up all the infrastructure around it. But if you don't have that entity set up, people won't take you seriously. And same with the United States. If you're going to go to the US to raise, get a Delaware C Corp. Easy peasy. Stripe has a product. It's like 24 hours. Again, $300. So infrastructure in either of those markets is not a problem at all. And then once you get an investment, usually the VC or whoever it is will help you through the rest of the process for like re-domiciling and setting up swap agreements between Sri Lanka entity as an OPEX and all that stuff. So I don't think structure or legal issues is any sort of barrier. And get yourself out there and ask for help. Ask other founders, make friends. One of my most successful startups has gone to every E27 event. They're from Bangladesh, and it's amazing to see the progress they've made. And they go to E27, and he talks to like everyone at the whole damn conference. I mean, the guy is such a hustler, but he's learned so much. If you saw how he communicated 5 years ago when we first invested to today, when he's raising it over $100 million, and he's gotten multiple investments along the way, it's because he got himself out there. He pitched all the time. He talked to everybody. He asked questions. And he got himself to that level where he needed to be to execute and raise funding. So,
Things like Spike are so popular in Sri Lanka because networking is key, particularly for the startup ecosystem. And how important is it to build that network as a Sri Lankan startup with Singapore, with the mentors and advisors? I know a lot of our ecosystem partners try and support the building of the network and setting up networks to get as much mentorship and advice as possible. And from your experience, how is the best way to go about it? So the question again to both of you.
I think the most powerful thing that Sri Lankans have is your extensive external network around the world. of successful people that are loving to support their fellow countrymen and women around the world. We work with N Ventures, and they've helped so many startups that they didn't invest in, and maybe they will, but they're so happy to help people with networking, lots of other organizations, and just individuals around, whether it's the US, Canada, UK, Singapore. I would start there. There's so many ways for you to ride the rails of your diaspora and get access to people that you probably wouldn't get access to, and people that I couldn't get access to if I was fundraising, because I don't qualify, unfortunately, as a Sri Lankan. So I would really just start there and maximize that as much as possible to get access and build out your network to start with. And then obviously those people will introduce you to other people who may or may not be Sri Lankan, and so on and so forth. But as a fairly small country, and still growing to kind of hopefully U.S. standards and other market standards soon, I think that's the way you can best leverage your resources.
So the advice I would give is on a few levels. So platforms like this are really helpful, and you guys should do whatever you can to support Spike, right? So if you're an up and coming founder, if you raise some capital, just sponsor a small amount of money for a meetup, and I think that could really go a long way. So on some level, right, support platforms like that, get involved, be helpful, right? And that when I started my entire founder journey and startup journey, I used to volunteer for events in the US. I used to do registration work and those kind of things. And what it allowed me is to be right in front and to meet everyone, right? And that's how I organically grew my network. That's one. Second thing is this, right? On some level, right, you're going to be able to learn from, let's say, players from Silicon Valley, from Southeast Asia and the likes. But at the same time, you want to be doing peer-to-peer learning among people in your own network, right? And that's relevant for the Sri Lankan market, because there will always be unique product issues or unique go-to-market strategies that are more relevant to your local ecosystem. So if you're a product manager, start networking with other product managers, build smaller communities where you guys meet regularly on a monthly level, exchange ideas, exchange tips. And this is where the ecosystem should be growing in a manner where it is automated, right? There's no government agency or private company that's nudging you in that direction. Ask yourself, right, if I could learn something from my peer tomorrow, what would it be? For about a good 7 years in Singapore, I was part of a founder network where we would meet, every month, and we would be accountable to each other, both on a personal level and a professional level. Because on a personal level, you want to get support, right, as a founder, and on a professional level, you want to be accountable to a group of founders. But we were also sharing problems around scaling, hiring, product issues, and each one of them was sharing their point of view and their experiences you've had. So organically start to build these kind of connections, right? On the third part, for whatever that you're building, there's definitely an equivalent in India, in Singapore, in Malaysia, Thailand, the US. Start connecting with these people, start learning from them, right? How they figure out their models in their own local markets. And in most cases, you'll see there's a lot of similarity that you can learn from and use to scale. Like in the very, very early days, the guys that I used to be close to were the guys in TechCrunch, right? All the way in the US. Literally, when the TechCrunch guys came to Singapore, hosted them, spent time with them, partied with them, did everything I could to learn their models. The same thing with Product Hunt, Venture Beat, AngelList, every one of them. And I use those ideas and also those uniqueness to figure out how I can use that for my own E27 organization, right? And last but not least, right, again, right, is balance it out. If you're a founder going to every event out there, networking all the time, and then completely neglecting all the core parts of your business, you're not doing it right. On the flip side, if you're just building, and not going out there to talk to customers, not giving back, not finding some kind of a balance, you're also going to lose out, right? So figure out what that right balance and cadence is, and then structure it into your life accordingly.
Already have one question over there.
Hello, my name is Kalan from MyBay. You covered a couple of ways where you can build up a warm introduction. When you're talking to a VC for investment, warm introductions are the best way to go. I think you covered networking events and accelerator. Could you also share a few avenues where Sri Lankan startups could get a warm introduction to a Singaporean VCs from your experience?
So there are multiple ways you can do that. Firstly, among all of you, right, I'm sure someone over here has spoken to Singapore VCs before. And if you have, right, learn to offer in the network to say, hey, I can help make introductions, and do that as well, right? Because the more Sri Lankan founders that you introduce to the VCs you meet, the better it helps from an organic standpoint, right? Second thing is, believe it or not, platforms like LinkedIn can be fairly helpful to get connections and introductions with. Don't neglect the analyst layer, right? too many times people are like, oh, I only want to talk to the partner and no one else. The analyst layers are the ones that are always on the hunt to look out for up and coming companies to profile, speak to and invest in. Give the analyst that 30 minutes of your time, build a relationship with the analyst, and hopefully the analyst will bring that relationship up to the partner level. So on that part, there's a cold part to it. The other thing is other investors. So investors like N Ventures, right? They're the ones also networking with other investors all across the region. Get them to help you organically, right? The last one is, of course, going to events or going to areas where there are physical ways to meet these investors. There are platforms that I run. The platform I run is called Echelon. It's a conference in Singapore. There are many other conferences that happen around the region. In fact, I'm thinking of doing a trip to India for work that I've never done before, and I myself am looking for events to go to. And when you can find events that are happening, there will always be a natural opportunity where you can reach out and say, hey, I'm going to be at the event. If you're going to be there, let's connect. A lot more people, especially for Singapore, a lot of people are very open and willing to meet in a serendipitous, organic environment, especially if there's an event tied to it. The last thing you can do is to start becoming a thought leader for your own platform. Right? We have a contributor program where anybody in this room, if you're a founder, investor, corporate, legal professional, you can create thought leadership content on E27. You can do so on LinkedIn as well. Start being a thought leader and start letting organic introductions come in, right? I've had so many founders who say, hey, look, the moment I got profiled on E27, I had like 20, 30 VCs, organically add me on LinkedIn and say, hey, let's have a chat, right? So build some level of organic introductions that come outward through some level of content marketing and PR.
To build a relationship, you need to build a string of dots that turn into a line. And a line gets you from zero to money. And a lot of times the first time you meet an investor, you're too early for them, or something's missing, or whatever the case may be. Add them into your monthly newsletter. You send that out. Hopefully within a year or two, you've got like 1,000 or 2,000 people on there that could be useful in some way. And later on, 6 months, 9 months, 12 months later, you got your numbers on there, they open it up and they go, oh wow, when I met Mohan, he only had $1,000 a month in revenue, and now he has $30,000 a month in revenue. That's really interesting. I'm gonna ping him for a coffee. So give yourself a warm introduction and do monthly newsletters.
Given a company that's fully based in Sri Lanka and not necessarily any presence in the ASEAN market, what would be, from your perspective, the best way for a company like this to break into the market or make their first move? And from your point of view, what would be appealing for you to accept them in the market, or even give them the advantage of doing business with them? And what might be something that will just put you off and not necessarily want to engage with them? Because sometimes there isn't much exposure, and even though there is exposure to the ASEAN markets, getting in that first step is a bit tricky.
So on the Southeast Asia side, Southeast Asia is it's many different countries made up, right? So it's like, kind of like Europe in that sense, right? You have a significant number of countries with a significant number of languages, culture issues, and all that. The first starting point I would advise you to do is to at the bare minimum, right, get some kind of a trip done to some of these markets. Go to some of the local events, go to some of the local community members, get a sense of how some of these markets work, what are the cultures like, how is business done, right, before you even go in and do financial or market-centric process. So get a feel of the market, because if you're not there physically, you will never really get a real sense of it, right? You can't judge the sensing of the market just based on the data and all that. Like a lot of people get that wrong for Indonesia, for example, right? 250 million people, so they're like, oh wow, massive opportunity. But when you go there and you really see for yourself how many cities are active, what the ARPU is for the users, you realize it's a completely different ballgame, right? Second thing is this, right? Before you actively expand into the market, figure out a few different ways that you want to do it. Some companies will follow a model where they will transplant someone from their home team into the new market, right? That's option A. Some companies will hire a local GM to figure it out. And in some markets, right, you have no choice to do some kind of a JV model. That's something you have to figure out depending on which market you go in, what's your cash flow and then financial situation, and what your runway is like to see whether that makes sense or not, right? So that one you have to look at every market individually and see how well that works. The third one is really competitive landscape, right? For most of the markets, especially from a hiring standpoint, it is already fairly saturated with a lot of big guys and a lot of up-and-coming middle ones, right? So if there is a way for you to position yourself such that you're you're looking at the Sri Lankan talent angle, figure out how you can educate the market on the opportunity from that standpoint, and then do some work around branding and positioning. For the rest of you, depending on the product that you have, you might want to really rethink, right, whether the market has the potential to pay for the product, what the lifetime value is for the market for you, but more importantly, right, what is the period to which the customers can convert. In some markets, for some verticals, it takes a lot faster to do. For markets like Singapore, you actually want to work with the government to get on some special list. Because if you can work on some grant-related programs, the market adoption for that is a lot faster. So some markets have these kind of unique things, especially if you have SaaS software, and in most cases, local companies will not use your software if you're not on a pre-approved government list, right? So those are some uniqueness about the market that you can think about. So I mean, without deep enough perspective on what the companies actually do, it's a bit hard to customize it, but on a high level, I think that's how you can go about thinking about this problem.
If you're going to do that, if that's your hypothesis, move to Singapore. You should be here. You should be next to your customer. So wherever that is, and it's another. So there's startup investor fit, which I talked about in my intro. There's startup geography fit, and about 10% of my portfolio companies are in the wrong country. We try to help them go to the best country. That's usually the United States. You can run an amazing business by having your OpEx and your cost basis in Sri Lanka and selling to Singapore or selling to the United States, or whatever that is. But Singapore is, first of all, it's a tiny market. It's packed with recruiting companies. So just be really careful when you're entering a market. Yeah, okay, there's more money in Singapore, there's investors in Singapore, but do you really have a customer base there that can scale? I don't know, it depends on your business. So just be really careful with that one. Keep track of where your customer mix is organically coming from. We have a startup, a marketing tech company in Bangladesh. And one day I started to do analysis with them on their customer mix, and it was like 45% United States, and they haven't spent a single dollar to attract or acquire any customers in the United States. We're now in the process of moving the whole company to the United States because they could probably become a unicorn there. They probably would not be a unicorn in Bangladesh. So I think it's really interesting to consider Singapore, but just be really careful because you can't do it halfway. You got to do it all in. And if Sri Lanka is the place for the next few years, that's great. That's much easier. But you're not going to raise capital from Singapore. And that's okay too. Just be really honest with these self-profiling questions and what the right strategy is to go forward. Because mistakes in the early days are really hard to recover from. Once you have Series A, you can raise enough money to do a bunch of experiments and make some mistakes and not pay such a price for it.
We are in the transitioning stage from just selling agriculture in Sri Lanka, which we've been perfecting for a period of time, to actually selling agriculture technology. We are in the process of containerizing our farm and selling it abroad. We've got our first customer, and we wanted to just have a chat and see what are the potential aspects of having something like this in Singapore, because there's a lot of incentivizations for growing agriculture in a very confined space in Singapore.
The longer answer is that if you look at markets like Malaysia, if you look at potentially markets like Thailand, there are some opportunities there. But the challenge again is that you got to have the right relationships with the right players that will allow you to install the infrastructure that you need in areas that allow for the infrastructure to be placed at a price point that is going to make the business sustainable. And interestingly, we are looking at a company in Malaysia that's doing exactly that right now, container-based vertical farm solutions, supplying to hospitals, hotels, and premium restaurants, right? So it is possible, but again, there has to be some level of unfair advantage or a unique relationship-centered opportunity that you have that allows you to do this in a scalable manner at a cost base that makes sense. So Singapore is 100% out. So it's just way too expensive. And the government, anything that's land-based, the government will never support it because they just don't have the land is just too scarce for them to make it work.
So even a containerized solution in Singapore, you're saying that wouldn't really work?
Organizations that have tried it. There have been organizations that have tried it on buildings, on top of buildings, inside buildings. All of them work good as pilot projects, which is something good and bad about Singapore, right? Singapore is a good pilot test bed for a lot of these ideas, but you cannot scale it simply because in your case you need land space, right? But that's where again markets like Malaysia, markets like Thailand, they have better opportunities for stuff like that.
And would you say the advantage a company like this would have is based on cost?
I'm sorry, I missed you there a bit.
Would you say the unfair advantage that the companies would have competing in this sector is based on cost?
No, the unfair advantage is access to strategic infrastructure, land, and markets, right, that allow you to utilize the tiny resources that you need, the container space in the land that you need, over extended periods of time. So it's really a function of the floor space and how much margin and how much value can you create from that over time without having some government agency or some big conglomerate pull that out under your rug.
Great. Answer number one, stay in Sri Lanka, just be the very best at this and scale the hell out of it and become a billionaire without leaving Sri Lanka. Answer number two, if you feel the need to experiment with new markets, find a distribution partner that has all of the resources and relationships and sales force to help you execute on this and do a profit share or revenue share.
The government plays a pivotal role in terms of startup ecosystem. So in Sri Lanka, we see the community trying it very hard. I would like to know key three things what other governments are doing, especially in Singapore and India. What are the three key things that the government is doing on behalf of the startup ecosystem?
I understand Sri Lanka's ecosystem that deep enough to be able to give you pinpoint exact policy, but basically the government's role is to play like a fire starter at first, right? And then let the private enterprise take over and ignite the ecosystem on that level.
I think Mohan did a great job on the macro side. Maybe I'll just give two specific examples for kind of a micro aspect. So my startup raised $500,000 directly from the Singapore government, and I'm not a Singaporean. So I'm not sure where else in the world that's even possible. But the program that my startup was part of is called TIS. It's been heavily modified and not the same because they don't need it anymore. But essentially what it was is the Singapore government filtered down to, I think it was 15 VCs, and said, we'll give you 5-to-1 leverage. So every dollar you invest, we'll invest $5. So for my seed round, we raised about $1 million. The Singapore government put in $500,000. The lead VC put in only $100,000. And we had other investors involved. What happens if we fail? If we fail, the government loses $500,000. The VC only loses $100,000. What happens if we succeed? We did. The VC was able to buy out the $500,000 stake in my startup from the government for a 2% annual coupon payment. What did that mean? That meant my VC, which only had a $5 million fund, was able to deploy $25 million. And 15 VCs times 5x is really powerful and jump-started the ecosystem. This was back in 2012. I think the program started through 2016, something like that. A lot of VCs in Singapore right now would probably not be there anymore without this program. And some of them are pushing $1 billion in AUM because of this program. So that's one example. Second example, more related to community building, is they basically took an old industrial estate, not downtown, but not too far, called Block 71. And so my startup worked out of there, our VC worked out of there. I think at the time they had over 100 startups and VCs working out of this space, which had heavily subsidized rent. They had an event space, and it was pretty cool. What does that do? That creates a locus, a kind of Silicon Valley area of Singapore where, you know, networking happens, people meet each other. I raised a bridge round from 500 startups at a place called JFDI, which was kind of an Accelerating Asia 1.0. Everybody in the whole ecosystem was there for events and things like that. So the government really facilitated that platform for ecosystem building. And it was an old factory that wasn't even being used anymore. So it was a fairly low investment, at least from Singapore standards. So I think those are kind of two specific examples. You can look it up and get research on that stuff. But I think Mohan did a really good job with kind of the policy and the other stuff.
How important an exit strategy is for the startups, and in the ecosystem, failing fast is crucial. And I just want to ask our startups and the founders who are here, who's really confident about their exit strategies? Because my next question is based on that, and if you have a question based on exit strategies, please send it this way. But yes, if not, what is your key 3 highlights for an exit strategy that's almost like a fail-safe? Is there a real fail-safe for exit strategies? I don't know, but what would your advice be, and what are the top 3 elements to keep in mind when you consider an exit strategy?
Number 1, be humble about it. So have an answer, but it's unlikely to be, assuming you get an exit, it's unlikely to be the one that you're talking about. Founders have a challenging balance to make, because when you talk to an investor, you need to convey that this is going to be the most amazing investment of this person's life, and you're going to be a unicorn, and whatever. You have to have that attitude, or else you won't fundraise. At the same time, that's extremely unlikely. The most likely way you're going to exit is another startup comes along and snaps you up, and you become a part of that startup. And hopefully that startup gets big, right? So one of the biggest exits in Southeast Asia is Grab. But Grab bought like 200 startups along the way in all sorts of different verticals and things. And a lot of those founders are really happy they sold to Grab because they IPO'd and they had an exit. But that's not a sexy story. Well, it kind of is if you have the Grab IPO, I guess. But for the most part, that's not the sexy story that is going to really get an investor to write a check. So, have your humility. I would say something like, well, here are 3 possible exits. First, it could be this, and have some backup points. By the way, one way to communicate any answer to any question like this is called the pyramid principle. You have your answer, you have your support, and then you have your backup support if you need it. This is a great example of that. So have your answer, but qualify it, make sure it's logical, but don't be too crazy like, oh, I'm definitely going to IPO on the New York Stock Exchange in 2 years, right? So that's a careful balancing act. But you have to be ambitious, but realistic, within the realm of being slightly crazy, but not nuts with your ambition, I think.
So I have met a founder, and in 2009, right, when you asked him like point blank, hey, what's your exit strategy? What's the long-term plan about this company, right? And he would very innocently and sweetly tell you, oh yeah, Nasdaq IPO. And he's a Malaysian guy, from Ipoh or Penang, smaller city, very humble, but like in that one word or line that he said, oh yeah, Nasdaq IPO, you would automatically just believe him and trust that this guy will have the tenacity, humility, and also ambition to build a company, right? And literally they were just announced last week to hit 100 million in ARR, and I'm fairly confident, right? They will get their Nasdaq IPO exit. So I mean, dreaming big is okay, and I think like Jeffrey, by the way, Jeffrey from PetSnap, right? He's a classic example of a founder that everybody likes to give an excuse about that. Oh, Southeast Asia doesn't have good founders, and then when you mention what about Jeffrey from PetSnap, and they're like, who is that? I'm like, see, exactly right. Nobody cares about the boring, unsexy businesses, right? Everybody likes to think of the sexy, popular ones. I think to take a step back, right? When it comes to thinking about the exit strategy, at least from an Orwell Ventures standpoint, right? It's important to know that you've at least done the mental exercise to think through, right, what a potential exit looks like. Who are the potential acquirers, or what is a reasonable exit level? It's perfectly alright to dream of a big outcome like an IPO, and if you have the plan and the business plan and the business model and also the projections to map it out, I think that's fairly reasonable, right? But a lot of good founders also, when I ask them, right, look, what if another company comes along and tries to acquire, right? Or what if you don't end up raising the capital you raise? And I think the right reasonable founder is fairly aware that at some point they have to figure out how to give back or distribute shareholder value, right? And what that means, right, actually, right, can be in many different forms. Giving back shareholder value could mean, being profitable and paying back dividends. Giving shareholder could mean raising new capital from new investors and making them buy secondaries. Raising shareholder value or giving back shareholder value could also mean raising capital and making sure that maybe 30% are for secondaries to allow investors to exit and 70% is for new money, right? So it doesn't always need to be pure play acquisition or pure play IPO. I can tell you as a guy that runs a media platform, 90% of the acquisitions that you read about in the media don't even return $1 back to most of the investors, right? So it's not even a real exit outcome, right? So my suggestion is broaden that idea on exits, right? Be profitable, be cash flow positive, so that you can actually take back control of the exit outcome, and you can actually then use your own coffers to deliver shareholder value and not be relying on a bigger entity, a larger competitor, or the next VC or investor down the road.
So just one thing to add, because this is how my startup exited, and it's really common, and we haven't talked about it yet. So strategic investment leading to acquisition. So my startup had Rakuten as a customer, and then their VC arm invested, so they became an investor. And then after 3 or 4 years of that relationship, they decided to acquire us. This is extremely common. I have like 3 or 4 friends who have exited their startup this way. Again, it might not be the sexiest thing in the world on the surface of it, but all of our investors were happy, successful exit. We weren't in E27 or any other magazine because Rakuten doesn't like to talk about these things, but that's very common. And it goes to another point from earlier, which is like strategic investment. Where to get investment from? Maybe it's your customer. You have big corporate customers that might be looking for innovative solutions to add on to their kind of traditional business model. Might be you. So another place to find investment and or potential acquirers is your customers.
So I have 3 quick announcements to make on behalf of our sponsors and also the other ecosystem partners. So one is from Acorn Ventures. Chandima is here from Acorn Ventures.
Sachin, thanks for giving this opportunity. So I'm Chandima. I think some of you know me from different worlds. So I'm from an entity called Iconic Ventures, and we work in the travel tech space. So Iconic Ventures is backed by Acorn Group, who's involved in travel, leisure, aviation services, operating in about 5 geographies, from Dubai to Cambodia, Sri Lanka, Maldives, Thailand, Bangladesh type of markets. So we really believe that how we travel, how we spend our leisure time is going to get an overhaul. One end from a technology perspective with AI and blockchain, and on the other side from the pressures of like the social norms being changed, sustainability, wellness, and all of that. So the opportunity and the invitation and the help that we need from all of you is, so we are running a model what we call a venture studio, so which means we invite anyone who wants to work in this space, who wants to create a startup in this space of travel, leisure, aviation, to join us. We do this through a 3-step process. So step number 1 is we run hackathons. We run 4 hackathons a year. We have done the first one. Our next one is on 2nd and 3rd of August at Hatch. So we run the hackathon 2 days. So it's a structured process. You can come with an idea, or you can come there with a team and figure out an area to work on. You pitch that. We reward 3 winners, and we invite them for a 4-week sprint, what we call, where you can work with the actual industry experts. You can speak to your potential customers. You can speak to airlines like Emirates, Malaysian Airlines, all of these people, and validate your idea further. You pitch again. And at that point, if you feel you want to really take a route of startup, then we have a program of actually supporting you for 12 months with some cash to stay alive and help you actually raise funds and all of that. So that's what essentially we do. So this announcement specifically is for people who are passionate about changing how we travel, how we spend our leisure time. 2nd and 3rd of August is our next hackathon, so please join that. Maybe through your network we can share the details. Thanks.
Right. So I'll go to the water tank. I'll keep it really short. So we want to thank the investors, the foreign delegates who have come here, and also Challenger from Inventors for bringing them here. And the Belani team. The Belani team Fast Scope for coming on board as well. Dominic and Nigel from Darfur. The community, you guys staying in the rain, thank you very much for coming to Spike over 10 years as well. Anudhi and the Spike team, thank you very much for getting together to organize this. Let's keep in touch and let's keep this going. Thank you very much, guys.